Hello and welcome. I am Vipul Mittal, and in this session, I will discuss goodwill amortization. And the question is that can you really amortize goodwill? Now, the general rule is that goodwill is tested for impairment and goodwill is not amortized. This is the general rule. But this is a general rule. There is an exception to this amortization rule that a private company or not for profit entity may make an accounting policy election to apply the accounting alternative. So they can elect this accounting alternative. And what is this accounting alternative? If elected, the accounting alternative allows an eligible entity to amortize goodwill. So they can amortize goodwill and test that goodwill for impairment upon a triggering event. So a private or a not-for-profit entity may elect to amortize goodwill, provided they make this accounting policy election. That is, they elect to amortize. So a private company or a not-for-profit entity that makes an accounting policy election should amortize goodwill and also test goodwill for impairment. When should goodwill be tested for impairment? Upon a triggering event. For example, negative cash flows. So if the entity has negative cash flows or its cost is increasing, competition is increasing, declining cash flows, all these are triggering events. And if there is a triggering event, then goodwill should be tested for impairment also. But the entity has to amortize goodwill. And the entity should amortize goodwill on a straight line basis. So the entity should use straight line method to amortize goodwill over a period of 10 years or less. So the amount recorded as goodwill in the books is amortized and allocated over a period of 10 years or less. So generally it is spread over a period of 10 years. You amortize goodwill over a period of 10 years. But if the entity can justify a lesser period, it is okay. If less than 10 years is appropriate, use that. For example, if entity says that, no, we want to amortize goodwill over a period of 7 years because 7 years is more appropriate. We can justify that. We can demonstrate that 7 years is more appropriate. Then amortize goodwill over a period of 7 years. So a private company or not-for-profit entity may make an accounting policy election. And if this election is made, they should amortize goodwill over a period of 10 years or less. For example, X company has goodwill of 700,000 in its books. This is the carrying amount of goodwill. And this is to be amortized over a period of 7 years, let's say. Entity feels that this is more appropriate and they can justify this. This is more appropriate. So this is amortized over a period of 7 years. So how you will record this amortization? At the end of the year, you will record this journal entry. Amortization of goodwill, debit, and Credit goodwill for $100,000. How you get this? 700,000 divided by amortization period, 7 years. The general rule is that goodwill is tested for impairment and goodwill is not amortized, but a private company or not-for-profit entity can elect to amortize goodwill. And in such a case, it is amortized over a period of 10 years or less if the entity can justify a lesser period. All right, students. So you can subscribe to our YouTube channel for getting more such content that helps you in your CPA exam preparation. Goodbye.